So your financial advisor only charges you 1.5, or 2% assets under management in addition to their annual fee? It's not a lot, right? It's just 1%. Find out in this video why 1% is a lot of money. We're going to do just a little bit of math, no big deal, and you're going to love it. Welcome to Money Med School, where doctors come to learn about money and do math, just a little bit of math. I wanted to do some calculations to determine how much 1% of assets under management actually adds up to over time, and what a financial advisor who charges 1% assets under management is actually costing you in terms of your overall return and how much money it really costs. So I did some calculations, and I'm going to show you what I've got here. So I made some assumptions. I tried to pick some pretty average numbers. So I chose a starting salary of $200,000, and this is after you have completed your training, at an age of 30 years. So if you graduated from college at age 26, if you graduated from medical school at age 26 and did a 4-year residency and no fellowship, then you would be starting your attending salary of $200,000 at age 30. I'm assuming an annual raise of 3%, which is probably pretty generous for this day and age, but 3% is a number that is accepted as a sort of an average increase in the cost of living, and so, or it's an average rate of inflation, and in order to keep up with the rate of inflation, your salary should theoretically be raised 3% annually. This is not always the case. In fact, I think it's probably an exception in this day and age, but I'm using this number here as an average. Annual contribution. I'm assuming that of your $20,000, you are contributing 20% of your income to your savings in order to invest it. And I'm assuming a 7% rate of return. I got 7% because 7% is the average rate of return of the S&P 500 over its existence, and that includes the, sometimes 25-30% annual returns and sometimes the negative annual returns. It's averaged over many, many years, and it adjusts for inflation. So the average return without adjustment for inflation is 11%, and the average rate of return with adjustment for inflation is 7%. So I use 7% as a pretty conservative number. Now, all that being said, let's come over here. So I have year 1 through year 35, and we're starting with an annual income of $200,000 in year 1. And it's increasing by 3% every year. So I just calculated out how much money that would increase to each year. So the first year you get a $6,000 raise, and then the next year $6,180, and it goes up from there. So that by the time you retire 35 years later at age 65, your annual income is $546,381. This is not adjusted for inflation. And that's to keep things a little bit simple here. Okay, so 3% annual raise, amount of the raise, and an annual contribution of 20% of your salary to your investments. So 20% of $200,000 is $40,000. That's what you're going to contribute to your investments the first year. And that divided by 12 is $3,333 a month. And I divided it by 12 in order to give you a monthly contribution, because typically that's what we tend to contribute monthly as opposed to annually. Then I calculated what's the annual balance of your account at the end of the year if you have a 7% rate of return. So $41,497 after 1 year of investing. This includes your contributions. So this isn't the money you made investing, this is your total amount of money invested and your gains. Okay, as I did this calculation, it started to get a little out of hand down here, and so I'm going to disregard these numbers down here for now because I was able to confirm accuracy up to about 10 years. So let's just say you use your financial advisor for 10 years, year 1 through year 10. Okay? And the financial advisor charges you 1% of your assets under management. So what that means is they're charging you a fee of 1% of the total balance of money in your account. So year 1, you've got $41,497, and their fee is $415. These are all rounded up. Okay, so total fees paid $415. The next year, you've got $87,144 in your account. You pay $871 in fees, and now you have paid a total of $1,286 to your financial advisor over the past 2 years. And as you can see, this goes up every year, pretty quickly too, because now that you are getting some more interest and compounding, the third year your balance is $137,268. Your fee that year is $1,373, and the total fees paid over the past 3 years are $26.59. Going all the way down, and let me add year 10 here. Okay, so after 10 years, in year 10, you have paid a total of $30,873 to the financial advisor. And every year this goes up because, as you see here, the first year it was $415, 1% of $41,497. By year 10, your total assets are $646,600. So 1% of that is $64.66. And after 10 years, you've paid a total of $30,873. This is not in addition to, well, this does not include if they also charge an annual fee, which many of them do. And this is only 1% of assets under management. Now I want to show you what would happen if that $30,873 had been invested instead of being paid to a financial advisor. So what I did was I calculated how much would $415, how much would the fee have earned if it was invested instead for 1 year at 7% return. The first year, $415 would have increased to $444. The second year, you'd start with $444 in your account. You would add $871 to it, and to simplify it, I added one lump sum annually at the beginning of the year instead of doing it per month, just for simplicity's sake, which you'd actually get a smaller return with that if you had were compounding your interest annually as opposed to monthly. So this is even more conservative. Okay, so you would have added $871 to your account that year. And after 1 year, it would be worth $1,407 as opposed to the $1,286 that you paid. Every year it goes up, and at year 10, if you had kept your $30,000 total and invested it every year in these increments, so you invested this amount each year instead of paying it to a financial advisor, you would have earned, well, your total would be $40,223, and you would have made about $10,000. So really, when you think about it, that 1% of assets under management not only cost you in total fees paid, which was $30,873 over 10 years, but it also cost you in the lost interest that you could have made if it had been invested instead. And in this case, that's about $10,000. So your total cost to the financial advisor was not only your $30,000 in fees, but your $10,000 lost investment. So it turns out that 1% is a lot more than it sounds. Just a little bit of math. Just a little bit of math. Just a little bit of math. Just a little bit of math.